In the decades after World War II, Japan transformed from a war-torn nation into an economic powerhouse, only to see their boom end in financial crisis and prolonged stagnation. Its economic miracle between the 1950s to the 1970s delivered the world's fastest growth rate and made Japan the world's second largest economy. But in the late 1980s, bubble in real estate and stock ended in disaster, ushering in decades of low growth, deflation, and huge debt. This video will examine Japan's trajectory through key phases: post-war recovery, high growth era, bubble and bust, and the lost decades, and analyze the policies, cultural factors, and global forces behind its rise and decline. We will use historical data and institutional analysis to explain both the triumphs and challenges of Japan's economy. Japan emerged from 1945 in ruins. Its cities were heavily bombed, infrastructure destroyed, and industrial output collapsed to only around 28% of pre-war levels in 1946. Shortages, hyperinflation, and famine were only averted by US aid, and the outbreak of the Korean War starting in 1950s going to 1953, which provided a temporary export boom. Under US occupation, broad reforms dismantled the old zaibatsu conglomerates and implemented land redistribution, paving the way for a more equitable economy. By the mid-1950s, Japan had regained its pre-war standard of living, and industrial production had fully recovered. In fact, industrial output surged from 28% of pre-war levels in 1946 to more than triple, 350% by 1960 as new investments poured in. A key turning point was Prime Minister Hayato Ikeda's 1960 Income Doubling Plan, which set a 10-year target to double GNP. Under Ikeda and bureaucracies like MITI, the Ministry of International Trade and Industry, the government actively guided investments into prioritized sectors. Average growth rates of 10 to 12% from the mid-1950s into the 1960s were fueled by the mix of public planning and private entrepreneurship. The government's role, via low taxes, industrial policies, and export promotion, helped turn Japan into a model of rapid development. By the late 1950s, Japan's economy was growing so fast that it became the world's third largest, and it joined the OECD in 1964 as a newly industrialized nation. Between the 1950s and early 1970s, Japan's economy grew at astonishing rates, averaging roughly 10% annually from 1957 to 1973. This miracle was powered by heavy industry: steel, shipbuilding, chemicals, automobiles, electronics, and rapidly rising exports. Japanese firms organized themselves into keiretsu, or corporate groups, with close ties to banks and MITI. For example, Citibanks, under the Bank of Japan's direction, overloaned funds to industrial conglomerates. Those firms in turn held cross-shareholdings and cooperated on technology and market strategies. This system, combined with relaxed anti-monopoly laws, enabled groups like Mitsubishi and Sumitomo to integrate manufacturing and finance efficiently. As Chalmers Johnson noted, Japan's growth is not intelligible without reference to MITI's role in coordinating the industry. At home, this era saw rising incomes, savings, and consumption. The average urban family's living standards doubled in the 1960s. For example, monthly households spent roughly double between the early 90s and late 1960s. Internationally, Japan ran large trade surpluses, especially with the United States, by exporting cars, electronics, and machinery. Indeed, by 1980, Japan had achieved the world's highest per capita GNP, reflecting its success in catching up with Western industrialized nations. Tokyo hosting of the 1964 Olympics and the construction of the Shinkansen, or bullet train, symbolized this transformation. Culturally, Japan's work ethic and group-oriented corporate culture underpin this growth. Firms practice lifetime employment and seniority-based promotion, fostering worker loyalty. Managers and workers emphasize group harmony, consensus, nemawashi, and decision-making, which some argue boosted social cohesion and productivity. This model delivered high savings, invested at over 30% of GDP by 1970, and stable industrial relations. However, it also created rigidities. For decades thereafter, Japan's labor productivity lagged behind peers, about 58% of US levels as of 2023, reflecting limitations of the old work culture model. The first major challenge to the miracle came in 1973. The OPEC oil embargo drove crude oil prices from $3 to over $13 per barrel, cutting Japan's industrial output by nearly 20%. As an oil importing nation, 96% of energy was imported. Japan was seriously hurt. A second shock in 1979, which saw oil top 39.5%, again slowed growth. These crises forced Japan to restructure, investing heavily in energy efficiency, electronics R&D, and less oil-intensive processes. By the mid-1970s, Japan had shifted from mass production to higher tech, capital, and knowledge-intensive industries, cushioning the long-term impact of oil price volatility. Concurrently, the global monetary system changed. The Bretton Woods dollar peg collapsed in 1971 and major currencies floated. The yen fixed at 360 yen to the dollar until 1971 began appreciating, reaching around 300 yen by the early 1970s. A stronger yen made imports cheaper and exports more challenging, but Japan compensated with quality improvements. Trade frictions emerged, especially with the US, which blamed Japan's surpluses for its own trade deficits. Those pressures culminated in the 1985 Plaza Accord, an international agreement to revalue currencies. Japan agreed to let the yen rise, which effectively loosened monetary policy domestically. The Bank of Japan cut rates, seeking to offset yen strength, inadvertently fueling excessive credit growth. The late 1980s saw an asset price bubble in Japan. Easy credit, lax lending standards, and soaring optimism drove land and stock values to unsustainable heights. Between 1985 and 1990, Japan land prices jumped by over 167%, and the Nikkei 225 Stocks Index Fund roughly doubled during 1987 to 1989. By December 1989, the Nikkei hit its all-time intraday high of 38,957 points, roughly a six-fold increase from the late 1970s. In this boom environment, many Japanese households and corporations took on debt to invest in real estate and equities. However, the Bank of Japan eventually intervened. Starting late 1989, it sharply raised interest rates to burst the bubble. Stock prices crashed first. By early 1992, the Nikkei had plunged roughly 50% to below 20,000. Land prices also began a prolonged decline, falling over 70% by 2001. The bubble's collapse proved catastrophic. Business bankruptcies spiked 66% more in 1991 alone. Wages fell and many loans sourced as collateral values evaporated. Despite these shocks, unemployment remained unusually low, around 2 to 3%, thanks to still high savings and some labor market insulation. But wages stagnated and corporate investments stalled. The 1990s ushered in what Japan came to call the lost decades of stagnation and deflation. Real GDP growth slowed to almost zero. From 1991 to 2003, GDP grew only about 1.14% annually, roughly the same 1% average between 2000 and 2010. By some measures, Japan's economy had flatlined. Nominal GDP in 2013 was back to its 1991 levels. Debt began to rise as tax revenues fell, and governments ran large stimulus budgets to revive the growth. Deflation set in. By the mid-1990s, inflation had fallen to zero and often turned negative. Consumers and firms expected price to fall, so they hoarded cash rather than spend or invest. In a classic liquidity trap, even near zero interest rates could not spur demand. Corporate Japan tightened its belt, wages, bonuses, and capital spending were cut. Over 1995 to 2023, Japan's real inflation-adjusted GDP per capita barely budged, and nominal GDP actually fell from 5.33 trillion to 4.21 trillion. Real wages dropped around 11% over the same period. One indicator of this malaise is the stock market. The Nikkei slid further after its initial crash, hitting a secondary low around 6,994 in 2008 and only reaching above 20,000 again in the 2010s. As the saying goes, Japan did not just have a lost decade, but effectively lost 3 decades of economic dynamism. Global influences added to the drag. The 1997 Asian financial crisis briefly shook exports, and the 2008 global recession caused Japan's GDP to fall by 5.2% in 2009. In contrast to the post-war era, Japan no longer had a strong export engine to pull it out of its slumps. Its aging society exacerbated the slowdown. The workforce began shrinking, and healthcare and pensions costs soared. By the 2000s, labor productivity already middling between a chronic issue. In fact, Japan's hourly labor productivity ranks very low. In 2023, it was only about 58% of the US level, placing Japan 29th out of the 38 countries in OECD. Analysts often cite rigid work practices, long hours but low per worker output, weak incentives for innovation, and low labor mobility as contributing factors. In response to chronic stagnation, Prime Minister Shinzo Abe's government, which ran from 2012 to 2020, launched Abenomics, a 3-pronged policy of monetary easing, fiscal stimulus, and structural reforms. The Bank of Japan aggressively expanded its balance sheet, aiming for 2% inflation, and interest rate were cut to zero or below. Fiscal policy included large public spending packages. However, structural reforms, labor market liberalization, corporate governance changes lagged behind promises. These years also brought demographic headwinds. Japan's population peaked 128.5 million in 2010 and is now slowly declining. The country's median age, around 49.5 years old in 2023, is the second highest in the world, with the fertility rate near 1.1 to 1.2 per woman, far below the 2.1 needed to replace the population. Japan faces a shrinking workforce and rising dependency ratio. These demographic trends amplify economic challenges. Domestic demand weakens, the taxpayer's base erodes, and fiscal burden grows. Abenomics had some mixed successes. In the mid-2010s, nominal GDP growth accelerated modestly, and the government debt/GDP ratio finally stabilized, albeit at an extremely high level. However, full recovery proved elusive. For example, by 2013, Japan's nominal GDP was only back at its 1991 peak, and equity valuations remained a fraction of their bubble highs. Deflation was finally addressed by unorthodox means. The BOJ introduced large-scale quantitative easing in 2013 onwards, and even negative interest rates in 2009. These policies kept inflation mostly below 1% through the 2010s. Only the global inflation surge of 2021 to 2023 pushed Japan's headline inflation above 2%. Meanwhile, the yen weakened drastically, hitting roughly 161 yen to a dollar in mid-2024, as Japan kept rates near zero while other countries hiked theirs. By 2024, Japan's economy is slowly growing, projected 1 to 2% annually, but still grappling with legacy issues. GDP per capita is below its 1995 level, and public debt exceeds 250% of GDP, the highest among major economies. Unemployment remains low, but unemployment and labor shortages in services are widespread. In comparative terms, Japan has fallen from its former elite club. It was surpassed by China as the world's second largest economy in 2010. and now ranks third behind the US and China. Growth rates, productivity measures, and living standards on a purchasing power basis are also lower than many peers. Japan's economic history is a dramatic arc of rapid ascent and sudden stagnation. Strong social cohesion, work ethic, and coordinated policy, government planning, MITI, big industry ties, propelled Japan to decades of record growth. Yet, this same system became rigid, and asset bubbles of the 1980s left deep wounds. Policymakers have repeatedly tried stimulus and reforms from the 1990s onwards to rekindle growth, but face new headwinds: an aging population, intense global competition, and the burden of debt. As of the mid-2020s, Japan must balance its lessons from the past, their virtues of fiscal prudence and a flexible market, with bold initiatives, innovation policies, immigration changes, digital transformation, if it is to revive and sustain its economy in the 21st century. Thank you for watching, and I hope you enjoyed. Make sure to like and subscribe and comment below what are your thoughts about Japan, the economy. Until next time, thank you for watching. Bye bye.